Welcome back. Interarch Buildings Solutions is buzzing in trade after reporting Q2 numbers. Stock has gained 4%. It's a 52% jump in the company's top line and a 65% increase in the EBITDA. Arvind, Nanda, Managing Director of the company, is now joining in to talk more. Mr. Nanda, it's been a very strong first half of the year. Your top line growth is in excess of 30%. When we spoke to you last time, 3 months back, you indicated that Q2 is typically a bit volatile, so you'll wait by to see. So you were sticking to your full year guidance of 17.5%, though you did say you're likely to beat it. Now that H1 has been so strong and your commentary is saying that this growth number is sustainable, what is the revenue guidance for the full year, FY26, and also on the margins, 10% or 10% plus?
Thank you for having me on the show. Yes, you are right. We seem to have done better than we expected. I think the monsoons and the usual problems that we normally face in the second quarter or the first quarter, we managed to overcome them. And I think we have also increased our capacity. So a lot of our turnover depends on our capacity. So the order book is good. Even going forward, our order book is still very robust. So I think the ability to deliver more to our customers, to produce more, to deliver more, to erect more, I think that has helped us. So I think we should be now upwards of 17.5% that we had predicted, definitely. So maybe nearer 20% is what I think we have given as a guidance even in our investor call last week after having done so well. And we have the ability to achieve that figure. Normally the first half is a little bit more critical. I think we have crossed that criticality. Second half is far more predictable.
So why not more? In the first half of the year, your top line growth is 39%. Are you being conservative when you say the full year growth number will be 20%, or are there more headwinds? And on margins, 10%, or you'll do better?
Well, I think the first half of last year, when we compare, the base point is a little lower. In the second half, the base point is a little higher. So it could even be higher, but we are not predicting that because in our business, because it's all a customized building, things can still get a little delayed in some large projects or some projects, and it could be. So it can. We are definitely trying to go full out. We are not going to hold on because we gave a prediction, but I think the prediction should be conservative because things can go up and down. Margins should improve. I don't know whether it will touch 10%. We are doing a lot of investment into plant and factories. And consequently, like I mentioned before, for pre-engineered building, it is an equal investment into sales, marketing, engineering, project management, which happens as well. And this has to happen in advance of the plants coming into production. So once you are in that cycle of increasing your turnover, increasing your output, then the expenses also start a little earlier. So I think margins should definitely go up. But since nearly every year we are trying to grow by 15 to 20%, there will be a little bit of a lag. And it's important for a company like ours. We are very fond of calling ourselves the Mercedes of pre-engineered building industry, and an industry which was pretty much unknown till a year and a half ago. I think it has come into a lot of prominence. I think the investment we must realize has to be in advance. And unless we invest into engineering and design and better quality, better deliveries, better erection or project management at site, we are not really a pre-engineered building company. We are not governed only by what we produce. So it's very important that we grow all around. And that is how we have grown over 25 years, step by step. This is not an industry which you can jump overnight. These figures, what we have got, I think are extraordinary. But otherwise, this is not an industry which you can jump too much, too fast.
Fair enough, Mr. Nanda. The intention of asking you that question was simply that since you mentioned that the second half is fairly predictable for you as a company, so you would have a better projection of what's going to pan out in the second half. And since your first half has been that good, it would only mean that the second half would be equally better, if not more. But be that as it may, what's your order inflow been for the year so far, FY26, the first 6 months? And how has the situation been on ground in the third quarter so far? We are into almost, a month and a half of the third quarter as well.
The order intake has been good. I think our order intake is very much related to how much we can deliver, because we cannot take more orders since pre-engineered building is a very short-term order cycle business. Nobody gives an order to us 2 years, 3 years in advance. Is maximum, even a very large order is 10 to 11 months. So we have an order book of, let's say, 1,630 crores, which we will be having to execute in the next 9 months, 10 months. Of course, we'll try a little faster. So it reflects that and is very robust. We have booked about 450 crores of orders in the last 3 months. And I think it has to relate to our turnover. So I think our ability to take more orders increases with our ability to deliver more. So there's no problem. The pipelines are very healthy. I think, as your commentators have also mentioned in the last few days, few weeks, private sector investment is also improving. And in the sunrise sectors that we are there, in the new age sectors, as we call them, the renewables, the lithium battery, your data centers, electronics, these are growing at a very fast speed. And more are changing to steel, and more are changing to pre-engineered steel, because that is the best way to build fast and go forward.
Right.
So we don't see any problem. I would say next 4 or 5 years in any problem in the kind of business we are in. A lot depends on how fast we can
Right.
do all our 4 legs. Yeah.
Got that. Mr. Nanda, we leave the conversation here. Lots of earnings to track today. Thank you very much for joining in. Get into a break. More on the markets when we return.